All right, the closing bell has rung on Friday, January 23rd, and wow, the market seems to be telling two completely different stories. You've got the Dow down, but the Nasdaq is up. So what is actually going on here? We're about to dive deep into a new analytical report that cuts right through all that noise. Let's get to it. So here's how we're going to break this all down. First, we'll get into the market's really weird split personality today. Then we're going to see what 5 economic masters would have to say about the psychology of what just happened. After that, we'll check out what the cold, hard data is predicting. And finally, we'll walk through an actionable AI-powered strategy to navigate it all.
Okay, so right out of the gate, the report dives into the split market. It's a real head-scratcher. Some indexes are up, others are down, and there's a fascinating story behind it. So let's get into it and figure out what's really driving this split.
I mean, just look at this. This table lays out the whole contradiction perfectly. The Philadelphia Semiconductor Index, that's the SOX, got absolutely hammered, down over 1.2%. That weakness dragged the industrial-heavy Dow down with it. But at the exact same time, the Nasdaq managed to climb, and the S&P 500 was basically flat. It's a classic tug-of-war. So what's the deal here? Was this just random chaos? Nope. The report actually zeroes in on 3 huge and totally conflicting events that all slammed into the market at the very same time.
And here's that tug-of-war in plain sight. On one hand, you've got this bombshell from Intel, whose stock just cratered, sending a shockwave through the entire semiconductor sector. But on the other hand, you've got this huge geopolitical win with tariff threats being taken off the table. And then, underneath all of that, you have this surprisingly upbeat consumer. I mean, talk about a perfect storm of mixed signals, right? Okay, but this report, it doesn't just stop at the what. It goes into the why. It actually analyzes the whole situation through the lenses of 5 legendary economic thinkers to get at the psychology behind the moves. Now, this is where things get really fascinating. So first up, we've got Gunter Dueck. His whole idea is that the market isn't this perfectly rational machine. It runs on emotional stories. And today was a perfect example. Investors heard Intel is weak and jumped to this big, scary narrative that AI profits are disappearing, and they sold off everything in sight, completely missing that the problem was really specific to just one company. Classic emotion over logic. Okay, next, we look at this through the lens of Saifedean Ammous. He'd point the finger straight at the central banks. His theory? Years and years of super low interest rates encouraged companies to throw money at weak projects, what he calls malinvestment. So from his point of view, Intel's stumble isn't a shock at all. It's actually the first sign of a much-needed, though probably painful, cleanup cycle. And then you've got Ken Fisher, who has a totally different take. For him, the market is like a big waltz. It doesn't just go straight up. So today's S&P 500 basically going nowhere, that's not weakness. That's just the market catching its breath. You know, taking a little breather on the dance floor before the next big move up in this bull market. So, remember that surprisingly strong consumer confidence number we talked about? Well, this is where John Castiani's theory of social mood comes in. The report argues that this wave of public optimism literally built a floor under the market today. It stopped a massive sell-off in its tracks and gave the Nasdaq the strength it needed to claw its way back into the green.
And last but not least, we've got Edward Dewey's cycle theory. When you look at that huge drop in semiconductor stocks through his lens, it suddenly looks a lot less scary. In fact, it looks predictable. The index had just hit the peak of a 40-month cycle that's been documented for ages. A pullback wasn't just possible, it was pretty much right on schedule.
Okay, so that's all the fascinating theory and psychology. But what about the cold, hard data? What do the numbers actually predict is coming next? Well, the report shifts gears right here into some serious quantitative forecasting for the week ahead.
So you might be wondering, how in the world do they forecast this stuff? It's not a crystal ball, I promise. They use these really powerful statistical models. Think of the Garch model as its volatility radar. It helps predict how big the swings are going to be. And the VAR model, that's kind of like the master detective. It looks at how all the different clues, like interest rates and stocks, influence each other to figure out where things are headed.
And so, what did the model spit out? Take a look at this. They're predicting a pretty solid comeback for all the major U.S. markets by the end of January. But get this, the semiconductor index, the very group that got crushed today, is forecast to have the biggest rebound of them all, jumping over 4%. How about that for a turnaround?
And that optimism isn't just limited to the U.S. markets. It's global. The report is pointing to really nice gains over in Europe, especially for Germany's DAX, and it's incredibly bullish on Asia, calling for a solid 5 to 6% jump for the Kospi in Korea and, wow, a massive 17.5% surge for Baidu, which the report singles out as a huge global player to watch. Okay, so the data looks optimistic, the theory is compelling, but the million-dollar question is, how do you actually act on this? Well, the report doesn't leave you hanging. It lays out a very specific, disciplined, rules-based strategy to navigate what's coming.
All right, here it is. It's called the AI Institutional Momentum Strategy. Step 1 is the portfolio mix. It's diversified, but heavily weighted towards the markets the models identified as the strongest. But, and this is key, it's not a simple buy and forget about it plan. The timing is everything. It uses really specific technical signals to tell you exactly when to get in and when to get out, taking all the guesswork and emotion right out of the picture.
And what's so brilliant about this strategy is that it's built to play both offense and defense. Your offense is all about capturing those big gains by riding the strong momentum the models have identified. But it's also got this really smart defensive move called a dynamic VAR hedge. It's a super simple rule. If that market fear gauge, the VIX, spikes over 25, the strategy automatically puts on a hedge to protect your capital. It's got your back. All right, let's wrap this all up. What's the bottom line here? What are the big takeaways from this report for the coming days? So here's the core message the report is sending, loud and clear. Don't let the noise and confusion of a day like today fool you. The underlying market strength is still there. This tech dip, it's a healthy correction, not the start of a collapse. And we're seeing leadership shift to the next wave of AI giants. So what's the final actionable recommendation? It is simple and direct. View these dips as opportunities and be an aggressive buyer. And that's our deep dive into this fascinating January 23rd market report. It really lays out a compelling case for data-driven optimism, which leaves us with a really powerful question to think about. When fear is everywhere, what do you trust more, the emotional narrative or the hard data? Thanks so much for watching.